Good evening, everyone. We would like to welcome to our Alpha Accurate quarterly investor conference call. I will now hand over the call to our founder and CIO Rajesh Kothari to start the session. Rajesh, bye to you.
Thank you, Amar. Good evening, friends. It has been always a pleasure to connect with you, all of you. This is our effort to keep giving the market updates through our quarterly conference call. And in fact, we are really overwhelmed by the response what we received during the last quarter, where we not only did the market outlook, but we also had a very deep dive into Indian specialty chemical sector. So we thought, to continue with the same efforts, and therefore this time, along with the market outlook, we are also going to give a brief about our views, and more importantly, how we do it internally on capital goods sector. So we try to keep it as simple as possible, and at the same time give some secrets, about analyzing the companies, identifying the companies, and how to create wealth in the long term by doing the right companies and right portfolio selection. So friends, without taking much of the time, let me start with a market outlook first, and then we'll talk about the capital goods sector. And before we do market outlook, there are many probably new participants, and therefore just two lines about Alpha Accurate Advisors. So we are a PMS firm, one of the leading PMS firm in India, with a vintage of 12 plus years. Few USPs, important differentiations are I am founder and founders are fund managers. Second, very important is client-centric business model. We do not have any business where there is a conflict of interest, only one business, investment management. Third important is, of course, we have the best of the tie-ups, Deutsche Bank as a custodian and fund accountants. Fourth, we have an award-winning track record. In last 12 years, we have delivered close to 20% compounded annualized returns compared to benchmark returns of about 11 to 12%. Very recently, we got award as the best PMS provider in the country by APAC magazine, APAC publication, one of the leading publication in Asia. So we are really thankful to all the investors, partners, distributors, and our friends and well-wishers. In terms of our investment philosophy, we strongly believe into not only wealth creation, but also protection of capital. Superior risk-adjusted returns, therefore, is something which is paramount importance to us. We try to reduce the risk by diversifying portfolio across market cap, across sectors, across companies. We try to reduce the risk by having a very, very strong discipline exit strategy. So for us, we strongly believe that buying right is only one leg of wealth creation. To make wealth happen, you need to also exit right. And that's something very important. In terms of stock selection, we have a very strong, unique approach, simple but effective 3M approach: market size, market share, margin of safety. And we buy the companies with the best governance, best management, best financials, and then very importantly, the market leaders. On an average, we meet one company a day. So we have a very strong due diligence capabilities, and we try to reduce that risk by investing into 40, 50 companies, and then we follow the exit strategy. So this is brief about Alpha Accurate Advisors and our investment philosophy, and a little bit about the track record. Now let me straight take you to the market outlook, and please give me one moment while I share my screen. So friends, during the recent times, the market has been extraordinarily volatile, and in last 2.5 years, after pandemic, we have seen now this, Ukraine, Russia-related war, making everybody kind of a little bit nervous, a little bit confused, a little bit fearful. So we thought to, put one slide, and in fact, this is what we have presented in our AAA Insights in the first week of March. So war is not new for the world and for the equity markets. In last about 35, 40 years, India has seen about 8 such events where there were wars, starting from 1986, 1991, 1999, 2001, 9/11, 2003, Iraq, 2011, and then March 2014. But if you study the history, the average drawdown, that is from peak, from the date of announcement, how much it went down is roughly 10%. The maximum decline was 22%. That was during 9/11 attacks. And if you look at the number of days market takes to recover, it is about 38 days on average. The maximum has been 49 days. And very surprisingly, this time also the decline was about 10 to 11%. On 22nd February, I think Russia announced that entry into Ukraine, and that's what created problem. Market actually declined by 10%. And in about 36 working days, 36 average days by, I think, closer to end March, Sensex is where it was pre such war event. So history, is always important, and there are always learnings from history, and history has repeated itself again. Just in about 35 working days, market is back to where it was pre-war announcement. So it tells you a lot of things, One, of course, during such headlines when war is at the peak, the crude oil was running about roughly $125. There are a lot of reports came out that crude will go to $200. And of course, when anybody writes such report, that's what that's what headlines grabs everyone's attention. And people become more conscious, So many investors might have actually thought that I will invest if the market goes down 10%. But when market declined 10%, with the oil at $120, such reports of $200, such noise from media or from wherever, it creates confusion, and investors might have, at times investors think, okay, should I invest today or should I wait for a few more days for better clarity? But market doesn't wait. And that's what it tells you. Market always gives a lesson that you need to be very, very firm and very, very disciplined when it comes to the allocation to equity market, and take volatility to your advantage. That's the biggest thing in last 3 to 4 years. That volatility, don't take it as your enemy. Take volatility as your friend and take it to your advantage. Because if you look at every year, in fact, last 20 years, last 30 years, last 40 years, not only India, but even if you look at world, every year market has declined. It is not that market has always been a going up kind of a market. There were always corrections. And every year, despite such drawdowns, if you have remained invested, then everybody knows that in last 20 years, market made 15 times returns. And the compounded returns, even if you would have invested the worst of the time, has been more than significantly better than the fixed income or any other asset class. So very important is take volatility to your advantage. Second very important question which everybody asks, particularly from last 4 months, and the questions even today remains the same. How do we see the impact of US Fed rate hike? And friends, this is not again something new. In last 20 years, there were 2 times when Fed has increased the interest rates. If you look at this chart, 2004 to 2006, the Fed rate was close to 1%, and from 1% it went up to 5%, 4.86. And during this time, Nifty went up by 95%. If you look at the 2015 to 2018 period, the Nifty delivered 35% return despite Fed increasing interest rate from almost 0% to 2.4%. So don't worry too much about Fed rate hike. Yes, definitely, significant higher interest rate is not good for the economy, but the moderate hike in interest rates is something which is not bad. In fact, it is good. And I will tell you why it is good in a moment. If you look at the S&P 500 behavior, and this is something very, very important. What happens pre-announcement and what happens post-announcement? And the zero line is a date of event, date of announcement. And if you look at market actually is ahead of time. So market gives correction before the announcement. And if you look at post-announcement, 6 months, 9 months, 12 months, market is actually given positive returns. And this chart is from 1950 till today. So it is a 72 years chart. And that's what the behavior of markets, global market, S&P 500 with reference to the Fed rates. So don't worry too much about interest rates. Yes, it is important, but what is the causing that interest rate hike is also important. Is it the inflation? Is it the demand? Is it the supply shock? What is the underlying strength of the economy? And third, very important is inflation. And here again, we have seen many questions, many queries, time and again from investors that what do you think if the inflation goes up? And this is again very important chart. Probably we also shared the same chart even our last quarterly conference call. Then if you look at last almost 30 years chart, this the blue line is corporate profit to GDP and the red line is inflation. And if you look at these lines, look at early stage cycle, when the inflation starts moving up from very low levels to little bit higher levels, actually it is good for corporate profits because the higher inflation is caused by better demand. Better demand means better capacity utilization and therefore better corporate profit growth and therefore better economic growth. And in that vicious circle, inflation again little bit moves up further and further creating the positive impact on the economy. So this is the time when inflation kept going up and market also kept going up. And therefore, Nifty went up 5 times in 5 years. 35-40% compounded returns people made because the inflation was also good, led by strong demand. And if you look at this time, and of course, if inflation goes up beyond a particular level, is a late cycle, is not good for economy and not good for markets, and both comes down and not good for corporate profits. And if you look at the recent times, the inflation has also started moving up. It is very, very low, just 1.6%. It's moved up now to 2.6%, and corporate profit to GDP is also moving up. So I would say that we are in early stage of inflation, but very important. Inflation this time is not caused by strong demand growth. It is a more of a function of supply shocks in the economy, whether it is a Ukraine-Russia issue, whether it is a China lockdown issue, or whether it is a freight-related issue due to one or other factors. It is a supply shock which is driving the inflation rather than significant increase in demand. And that's a good news to us because supply shock is not permanent. It is a one-time, it is a event-led. While one doesn't know that by when that event will be, probably will get over, one certainly knows that the time of such event cannot be very, very long term. And to that extent, one should not worry too much about increase in inflation. As I said, inflation is good for economy. Some inflation and some interest rates are good for equity markets and good for economy. In 2022, early, we said 3 important things for current year. 1, equity to outperform. And clearly, with rising interest rates, debt market is definitely not a good asset class to invest. Second, we said bottom-up approach because we believe that unlike 2021, in 2022, it will be an acid test for corporate earning growth. And lastly, we said active investor management. And I'm sure with markets volatility going up every day, active management is very, very important because the data points keeps changing. Positive or negative surprise are very likely. One important theme which we have been talking about since last 2.5 years is that big is getting bigger, and that is happening across the sector. But important is very recent times in last 2.5-3 months, we have seen 3 major announcements validating our thesis that big is actually becoming bigger, and not only bigger but also better. Like HDFC and HDFC Bank proposed merger, creating India's 2nd largest and world's 8th largest banking institute. Definitely something which is going to create a lot of, I would say, new environment for existing banking. PVR and Inox both getting merged, 50% market share in multiplex, creating giant in the cinema theater business. And lastly, Axis Bank acquiring Citibank's business and becoming the 4th largest credit card and 45% increase in their wealth management business. So big is becoming bigger, and that theme is going to continue. The companies with a dominating market share, with the best of the balance sheet, they have a power, they have an ability to acquire somebody or to attract someone as a partner and getting itself merged with the other entity to make itself bigger. So one thing clearly corporates have understood, that size matters, the scale matters. The world is changing fast, and therefore the economies of scale from cost perspective, from technology perspective, from consumer perspective, from the overall operational efficiency perspective is something very, very important. And if you have a size in your favor, it will give you different kind of a competitive advantage, which probably was not present till yesterday. And India is a market where there is a lot of fragmented market across various sectors, many small firms, many mid-sized firms. If you look at total number of listed companies, about 4,800 to 5,000 listed companies, only 550 companies makes 100 crores profit. So that shows that how difficult to make 100 crore profit. But if you merge with somebody or if you acquire somebody with the right valuations, and your profit becomes 300, 400, 500 crores, it becomes extremely difficult for competitor to compete with the same terms and conditions. So this is something which is going to continue as we speak. Second important theme is capital expenditure, and we'll talk in depth about it in the second session. And third important theme is China plus one. And we said that China market share versus India market share, there is a huge opportunity across multiple sectors, whether it is a specialty chemical, whether it is a pharmaceuticals, whether it is agrochemicals, whether it is a dyes and pigments. And in our last investor webinar, we had a very detailed discussion about one sector, which is specialty chemical. And in last 1.5 to 2 months, as we keep meeting the companies across many companies in specialty chemical theme, we are seeing more and more confidence into their capabilities to attract the large orders from multinational companies. In fact, few of the companies, they were mentioning that this Russia-Ukraine war is further creating better environment for China plus one India. And India, therefore, has a very strategic competitive advantage currently to take the benefit of that situation. So this theme continues, and we continue to remain very bullish on this theme. Let me now take you this new slide. This is something which we have created to make very easy for our viewers and our investors that how one should look at the opportunities. And if you look at this chart, we have a current environment on x-axis and future environment on y-axis. And we have put it into 4 quadrants: current decline, future decline, category 1, which is a avoid category. Current growth, but future decline is kind of a red signal. You need to be very, very cautious about it if you are holding in your portfolio. Current decline, but future growth, definitely you should look into it because market is all about future. It is never a rear view mirror driving. And current growth and future growth means company is growing currently also and is likely to grow in future also. Of course, that is the best things to get position for. So if you look at our portfolio positioning, our entire portfolio is positioned into growth category. 90% of the portfolio companies are growing in the current environment despite tough conditions, supply chain issues, pandemic issues, lockdown issues, raw material cost issues, and many more such issues. Despite that, they are growing. Third quarter results have been already out and they have done extremely well. And we expect them to continue to grow in future as well. There are 1 or 2 sectors where currently they are under challenging scenario due to particularly supply chain issues, but we expect them to do extremely well in future. Say, for example, automobile sector. Otherwise, all other sectors, whether it is a consumer discretionary, whether it is a capital goods, whether it is a retail, whether it is telecom, most of these sectors are likely to do extremely well in terms of the growth for next 2 years. In automobile sector, particularly, the sector has been hit hard because of semiconductor related issues. The demand is not an issue, supply is an issue. And therefore, we are positive on this sector with a view of around another, probably 1 quarter or so can be a little bit painful, but after 1Q, after the June quarter, we expect this sector to bounce very nicely in terms of growth because the supply issue, semiconductor chips related issue, we expect them to get resolved. In terms of how our positioning is right now, we are holding roughly 25 to 26% into banking and finance. Within banking and finance, we continue to own the large private sector banks and of course the largest public sector bank. And also we are holding 2 very important high growth NBFCs, both Bajaj Finance and Cholamandalam Finance. In consumer space, we roughly hold about 17% of the portfolio. However, as I said from last 2 to 3 webinars, then within consumer, we do not have consumer defensives. We are holding consumer discretionaries. Within consumer discretionary, we are very bullish on real estate space, but we would like to buy any real estate company due to governance and balance sheet issues. So we are playing it through consumer building material, roughly 6 to 7% of the exposure into the consumer building material companies. These are the companies which will gain significantly because of revival in real estate, because of the revival in the overall country demand growth. And of course, they're the best of the brands with best of the distribution network. So say, for example, largest plywood company in the country, largest wire and cable company in the country, largest pipes and tube company in the country, and so on and so forth. Software, we are holding roughly 12 to 13%. Capital goods is the theme on which we have turned positive from last 1 year, and we'll talk in depth why we are positive. Specialty chemical, close to our hearts from last 3.5 to 4 years. We have been early mover to this space, and we continue to own 8 to 9% in specialty chemical. As I mentioned earlier that most of the chemical companies which we hold in our portfolio, they are largest in terms of market share. They have the very strong capital expenditure plans for next 2 to 3 years. Many of these companies are expanding capacities. They are almost doubling capacities over next 4 to 5 to 6 years. Few of these companies, they have received the large orders from the global multinationals, and that is giving them further visibility to drop a next capex plan, which probably may come over a period of time. So right now it is on drawing boards, and that's another very good sign for us. In automobile, we hold 6%, and within that we have automobile as well as auto ancillaries. And we expect auto ancillaries are going to get significant beneficiary, particularly when you do bottom-up analysis. So this is a sector where one needs to be very, very careful, because many companies may not remain in future, because as automobile change from IC engine to EV engine, the old traditional companies who have exposure only to IC engine, they may not remain relevant. But at the same time, there are companies which are positioned for change in auto component, change in usage, more sensors, more airbags, more alloy wheels, and more EV related product. If you can identify such company, that's what we have done, the growth can be significant. Pharma is roughly 5%. We continue to remain very cautious on pharma sector, and therefore our weightage is very low. Within that, of course, we are very bullish on crime story, and we like 2 companies in this space. Both have the best of the capabilities, and they have proven abilities, not only in terms of the cost efficiencies and scale, but importantly, in terms of their purity standards while serving to their customers. Both of these companies, they're enjoying very high level of EBITDA margin. One of the company which is in mid-cap space enjoy EBITDA margins as high as about 35 to 40%. And that shows again what kind of pricing power they have while doing such business. One of my very important slide, every presentation, I keep repeating this point. Market is nothing but mirror of earnings growth. If the earnings growth is going to become stronger, market will keep delivering that numbers irrespective of macro issues. And that's what one needs to keep focus on. We continue to believe that last 3-4 years were a painful time from reforms perspective, volatility perspective, pandemic perspective, supply chain issues perspective. And despite such challenging environment, corporate India has done extremely well. In fact, corporate India has done much better than what anybody could have thought of 2 years back. And therefore, we believe that India is at inflection point from earnings growth perspective. Undoubtedly, the 4th quarter and 1st quarter are going to be impacted, and we believe that there might be downgrades in corporate earnings because of the very high level of inflation caused by Russia-Ukraine war issues. But we believe these are not long-term issues, and we expect that to resolve maybe over a period of another 2, 3, 4 months. And as that comes back to normalcy, we expect margins to again start improving from second quarter onwards. So yes, there might be some downgrade in FY23 earnings, but we do not expect it's a long-term trend. We believe that banking balance sheets are very, very cleaned up and credit growth is likely to improve from current subdued level of below 10%. So we remain positive on corporate earnings growth, and therefore we believe that in the long term, market should also do reasonably well as earnings growth improves. One slide about our PMS is a pure multi-cap, 50% large cap currently. We are 26% mid cap and 20% small cap. 89% of the portfolio companies, they are large in terms of profit size. They make 100 crores plus profit, a rare phenomenon in the corporate India space. Most of our portfolio companies, they have a zero debt on the balance sheet, or they have a very low leverage, and they have a strong earnings growth and very high return on net worth. One very important line, which I would like to reemphasize, all our portfolio companies are market leaders with the best of the management, best of the governance, and best of the financials. Earnings growth is very critical. If I look at our portfolio companies' earnings, we expect earnings to grow by about 37% in FY22 and then 36% in FY23 compared to Nifty earnings growth of about 14 to 16% in FY23. So our portfolio companies are rightly positioned to take benefit of consolidation. They have already gained market share in last 2 year challenges. They have the best of the balance sheet. So if the interest rates are likely to go up, maybe about 100 to 150 bips over a period of another 18 months or so, our portfolio companies are going to be positively impacted by it because they have a zero debt on their balance sheet. So if your competitor has, say, 5,000 crore of debt, definitely your competition would have some stress. On the other hand, our portfolio companies have a surplus cash. So actually their other income will go up because interest rates goes up. So they are rightly positioned to take benefit of this inflation and supply chain and interest rate shocks. Valuations, market is reasonably valued currently. If you look at last 10 years, price to earning basis as well as price to book basis. So it is not overvalued. Yes, there are some pockets where the valuation is a little bit on the higher side, but by and large, we are not too concerned about the valuations. I think as the growth improves and as the return on net worth improves, current valuations are justified. This is our performance since last 12.5 years. We have delivered 19% compounding compared to benchmark BSE 500 return of 12.3% and Nifty returns of 11.8% and mid cap and small cap returns of about 12.5 to 12.7%. So our strategy remains the same to keep delivering the superior risk-adjusted returns by investing into the best of the companies and following a very disciplined exit strategy. Let me now give 10-15 minutes brief about what is our view on capital goods sector and how one should look at this sector from here on. We'll talk about it in 4 slides. Early signs of revival, government push for capital expenditure, what are the new growth areas, and lastly, what is our strategy? Friends, before we talk about the future, let me tell you that what are the important parameters which one needs to consider to decide whether we are at the inflection point of CapEx cycle or not. Because CapEx is ultimately a cycle. It is a cyclical thing. These are not structural things. And therefore, it is very, very important to monitor key parameters that where they stand today. And if you look at last 22 years, you can see there are different phases. Like 1998 to 2002, it was a down cycle. And if you look at the parameter like gross capital formation, few important demand indicator like metal price, very important because if the metal price goes up, the capital expenditure comes on stream. Some inflation is very good. So some higher the inflation, better it is for some part of the economy. Cost of debt, very important. The lower cost, better it is so that entrepreneurs can spend more. Corporate credit growth is an important indicator. If it goes up, it means that CapEx has started. And of course, what is our current capacity utilization? These are the few important, I will try to make it as simple as from a layman's perspective. So 1998 to 2002, it was a down cycle. Capital formation growth was very, very muted at 4%. Metal cycle prices were just 8 to 9%. I'm talking about 1998, that time, if you look at the real inflation, probably would not have been that low. So 9% metal price compounded is not that high. Cost of debt was very high, double digit. Corporate credit growth was not that bad, but capacity utilization was about 80%. And then 2003, the early recovery, the capital formation growth, 23%. Why? Because the metal prices have reported 12% growth. Inflation remained modest. The cost of debt came down drastically. The corporate credit growth also improved. Capacity utilization also improved. As a result, we have seen the better GFCF growth. 2006 to 2008, it further accelerated. Metal prices went up, 21% compounding. Inflation went up. Cost of debt moved up. Corporate credit growth sustained the double digit, very, very healthy, actually 24%. Capacity utilization moved up to 90%. So kind of a peak of the cycle. And then the late cycle, where metal prices sustained, inflation further went up, cost of debt remained high, capacity utilization, it started impacting the economy because it cannot sustain such high inflation. And therefore, then capacity utilization dropped. And that led to a down cycle of last 4 or 5 years. Where we stand today, we believe that metal prices have already moved up in last 1.5 to 2 years. So metal prices growth is more than 8-9% regular growth. In fact, many commodity prices went up by 3 times, 4 times, 50%, 60%, 80% in last 15 months. Inflation has already started moving up from 1.6%. We are almost close to 4-5%. Cost of debt is still very low. Even if it goes up from 8.1, it may go up by 100 bips, not that very high. The corporate credit growth is very low, and we expect it is bottoming out. The last 3 months, RBI data is already showing the early signs of revival. And capacity utilization from low 70%, which got impacted because of pandemic, the economy is becoming normal. GST collections have already become very encouraging. Demand growth has slowly started improving. So we are into the early recovery phase. From down cycle, we are into early recovery phase. And you know what happens? When you catch them young, you can actually make exponential returns. So if you look at 2003 to 2006, when Nifty went up by 5 times in 5 years, the BSE Capital Goods Index went up by 15 times in 5 years. 15 times. So you can actually make real returns if the cycle comes the way in which you think it should. Few important drivers. Corporate balance sheet is very important. In last 2 years, despite pandemic, if you look at the free cash flow, excluding Reliance and entire software sector, the net debt has reduced drastically, almost 180,000 crores. The free cash flow is improved from less than 500 billion to close to 2,200 billion. So every corporate has done cost efficiencies, cost savings, and so on and so forth. And revenue growth kept coming in. That resulted into very strong corporate balance sheet. Very important. The borrower health is very important from lender's perspective. Let's look at the lender's balance sheet. The gross NPA was almost like 13-14%. It has started reducing and now it is below 10%. The net NPA actually has reduced significantly, and credit cost, very important. If you look at the credit cost, has also resulted into significant decline compared to last 4 or 5 years. And combination of this will result into ability of lender to give the lending to the right borrower. So corporate credit growth, which was about 11, 12, 13% 5 years back, has reduced to 7 to 8 to 9%. We expect that corporate credit growth to improve from 9% to 10, 11, 12, 13%. And as that happens, because the borrower is the best of the balance sheet and lender is also on a cleaner balance sheet, you have the right combination to have the better credit growth. From where the credit growth will come? revival of capex. Three important sectors: cement, steel, and non-thermal. Cement industry has already announced capex of 160 billion. Steel industry has announced capex of 750 billion, and non-thermal has announced capex of 900 billion. If you combine the capex of next 3 years compared to last 3 to 4 years, it is a 134% jump. And these are not the estimates. These are the actual announcements made by cement companies and steel companies and non-thermal power companies. Total capex is likely to be higher by 4,300 billion. And joker in the pack is, of course, PLI scheme. The total incremental capex over the next 5 years is expected to be 4.4 lakh crores. And that is spread across different segments, largest being semiconductor, followed by EV battery, automobile, specialty steel, textile, solar PV, mobiles, pharma, white goods. So it is across different sectors. So entire ecosystem is going to be built by India, and India is going to get tremendous advantage on cost side because you will get the economies of scale. It will make India globally cost competitive, and therefore it will further help India to grow its exports apart from catering to the domestic market. It is a multiple benefits. On one hand, India will reduce its import bill and therefore the savings on dollar. On the other hand, India will improve its cost efficiency. It means it will become a globally competitive player. On the third hand, it will actually reduce the inflation because we have a dollar inflation in India inbuilt. As imports reduce, our dependency on that will also reduce, and so on and so forth. So it can create a new wave of a next level of GDP growth compared to current level of 5-6%. Can we move to 9-10-11%? Our dream of GDP is possible provided all these things goes right. Very importantly, changing landscape in capital goods sector, traditional growth drivers. Historically, I remember my 2002 days when I was fund manager at DSP BlackRock. Whenever we used to get excited about capex, we used to buy companies which are into road, ports, EPC, construction, irrigation. These were the growth drivers. And of course, it created huge wealth during that time. But most of the capex was, even companies, if you look at it, the capex was for increasing capacity. But today, there are new growth drivers. While these growth drivers remains, road construction continues, the railway continues, the port expansion continues, airport expansion continues, normal greenfield continues. But apart from that, you have a new growth drivers, data centers, renewable energy, EV infrastructure, robotics, automation, and efficiency-driven capex. It is not only about greenfield, but even if company has a current plant, it needs to be cost competitive. Labor cannot come because of pandemic. Your plant has to work automated, and therefore it improves your efficiency. And these are the new growth areas for the Indian capital goods sector. Let me give you a few examples, like data center. I'm sure all of you would have heard about the top 5 companies in the world. They have already announced the big capex plan for India to set up their data center. The market is going to reach about roughly 2,000 megawatt, almost 5 times from current level of 500 megawatt. And that's the capex of 60,000 crores. Completely new. This was not there till yesterday. The renewable fossil fuel, non-fossil fuel, 3 times capacity addition. That's huge. Robotics. If you look at the India usage of robotics, we use only 6 robots per 10,000 workers. And if you this compare to world, it is 100 plus. In China, recently we were talking one of the largest company, in India, ABB. And if you look at, they were talking about the total robotics usage in China. I mean, it is a multi-fold compared to where we are today. So the opportunity is huge. It's an immense opportunity. It's all about how we can execute it. The size, the demand is not a problem. It's all about how can we meet the demand at that cost competitive price. Let's look at what are the top companies in the recent commentary, what they have talked about, like ABB, very bullish on capex story. Axis Bank, one of the largest lender, also shown a very promising restart of capex. In fact, Kumar Mangalam Birla has talked about capex Mahotsav for next decade, and he's been very vocal about it, that he expects the capex Mahotsav for next 10 years for India. L&T, the largest Indian capital goods company, has shown very high level of confidence of strong order book growth and of course maintaining the margins. And last but not least, and this is across sectors. I'm just giving you, 3-4 names here, but across companies, we have seen in their commentaries, in the results, that they've been very upbeat about, the capital goods sector. We hosted, very recently we talked about, Cummins MD. We hosted Mr. Ashwath Ram in our AAA Winner Series webinar. Can I play here? Just a minute. So basically, and Ashwath Ram is a 30-40 years experience in Cummins, very respectable name, and I'm sure everybody knows Cummins India as well as Cummins Global is one of the is the largest company in DigiSet and at the forefront of technology. Probably they have made investment of close to $1 billion into the world, into all new upcoming technologies, whether it's hydrogen or you name the technology, they are everywhere. And if you probably you can go to our website and you can hear his entire interview, because it's a rare phenomena. Mr. Ashwath Ram talking about entire Indian capital goods sector and Cummins India in particular. And he said that India is at the inflection point. And if you look at, he compared China versus India, that where China was 10 years back, 20 years back, and where India is currently. And he said that, this is the time where the capex is going to restart. He expressed his very high level of confidence. And he said that probably this can continue for next, not 1 to 3 years, but 5 to 10 years. Because if India wants to achieve its aspirational target of $5 trillion GDP, we have to do capex. Without capex, we cannot become $5 trillion GDP. Let me quickly take you through what is our investment framework. We believe that capital goods scenario has changed. 10 years back, it was different. Today, it is different. As I said, 10 years back, it was construction companies, EPC companies, long order book, long cycle order book, 5 years time frame for order book. Those things have changed now. Cost competitiveness, very important. Scale, very important. Localization, very, very important. Product portfolio, platform-based solution, R&D, technology. Do you have export opportunity? And of course, the balance sheet strength. These are the few important parameters based on which we decide what is a company's competitive positioning. If you look at the Indian capital goods, it is very, very fragmented. The number of listed companies, 300 and plus listed companies. Out of that, only 31 companies are 100 crores and above. Only 31, it means only 10%. 90% do not meet the profit of only 100 crores. And within 31, we have selected 5 to 7 companies in our portfolio based on the framework. So we believe that any company wants to be successful in India, they cannot rely on imports for the long term. You need to develop the scale. You need to have a localization, because if you localize, you don't have the import duties, your cost comes down and the quality is under control. Very important, scale. India is a very, very fragmented, so at times scale is very difficult. And this is a very big challenge for most companies in India across different sectors. So some scale is very, very important. If you don't have scale, you will not be able to make money. Cycle of orders. Earlier, there used to be 10 years, 8 years order book. No more. Now, even if you don't have 8 years order book, you need to have a short cycle orders. You need to cater to the sectors where they give 3 months order, 6 months order, 9 months order. So you do not see 60% decline in your revenue, 90% decline in revenue, what we saw in 2009 and 2010. Whether you have a cost competitiveness so that you can export, because China plus one is a big opportunity for Indian capital goods sector. If you have a scale and if you have a cost in your favor, you have an export opportunity. And last but not least, technology is a mode. No more your execution capabilities. Execution is only part mode, but you should have a technology, the research and development. That is a very important thing. Let me give you one example, simple example. ABB, I'm sure everybody knows this company. This company has a number of products, is one of the largest product portfolio across the different sectors, catering to oil and gas, power, you name the sector and they are present. And if you look at their recent, we try to analyze 70 to 80% of their business is currently into the high growth areas, data center, renewables, electronics, and only 15% or 20% of the business into moderate or low growth areas. So if you look at their order inflow, the order inflow growth, which was degrowth or very flattish growth in last 2 years, this year they have seen very strong double-digit 30% plus order book growth. And that's big number. 30% plus order inflow growth is a very big number. What is the difference between ABB today compared to when we look at any capital goods company 10 years back? Let me give you one simple example. There is a company called, which is into oil and gas company. And the biggest problem of this company was there is an uneven distribution of gas. ABB introduced their SCADA Advantage system. It facilitated the advanced control, real-time monitoring of gas flow from remotely located control room. And this is very important, where manpower cannot reach, your person cannot reach. But you need to make sure that whether the gas is going to every consumer or not, you need to balance it. And they have a very unique product, robotics and automation. ABB is known for that. So this is something very, very important, that what kind of a product portfolio a company has to make sure you can fulfill the demand. It is no more about the traditional capabilities across all of our portfolio companies. So we are holding currently 6 to 7 companies in our portfolio in capital goods. All these companies, number one, they are backed by the strong promoters. Most of our portfolio companies, they are multinationals. So they have a global parentage. And when you have a global parentage, you have a global technology as a mode. Nobody can compete with you. Most companies in India that even cannot compete because they don't have technology as a mode. Whereas our portfolio companies, they have a global parentage and therefore they have a technology as a mode. Once you have a technology as a mode, you are very, very fast in developing the products suitable to your customer. What ABB in India, customer might have different requirement compared to ABB in Europe. But ABB is not only catering to Europe, ABB is also catering to South Africa, ABB is also catering to China. So it's very easy to locate the right solution for the customer and then customize it based on its own engineering capabilities. This is something very, very important. It is because of that, most of our portfolio companies, they not only have the long-term order book, but importantly, they also have a short-term order book cycles. And this is very important. So there are companies which are placing order, which are to be executed over just next 6 months or 9 months or 12 months, because these are process improvement order book. These are not government orders of 10,000 crores. And you don't know what will happen to your receivables. That's what happened in 2002 to 2006. These are things which are coming from the private sector or public sector, short cycles order, high margin order. Most of the, for example, products of ABB, 75% is a product business. Service business is very small. 75% is product business. And that's again your mode. So our portfolio companies have a global parentage, technology as a mode, superior research and development, very wide product portfolio. Because of China Plus One, many of our portfolio companies, the global parent companies, they have identified India as a sourcing base. India market is also offering good scale. On top of it, they have export opportunity because they are cost competitive. To give you one example, Cummins, they have only 3 plants globally: North America, China, and India. That's it. So they are very clear which plant will cater to which market. And that's a huge opportunity for Cummins India. Likewise, companies like Timken has increased its exports after acquisition of one of the company in India. So the export opportunity is increasing because these companies have already demonstrated the cost competitiveness and very high quality of products. And that is something which we get proud of from our Indian companies, that with the Indian talent, they could develop the R&D, and with the right products, now they are becoming a largest exporter, catering to not only Asian economies, but also catering to Europe and at times even to the US market. And this is something so all of our portfolio companies, they have such characteristics. Needless to say, they are the best of the balance sheet, zero debt. So they are not going to worry about any shock on the interest rate side. And very importantly, if the infrastructure capex growth becomes bigger, like for example, railways, roads, airports, ports, then that will further add to the growth of these companies. So brownfield expansion, greenfield expansion, PSU capex, government capex, private enterprises spending, process automation related spending, robotics and automation implementation, all these enablers will help these companies to grow their earnings significantly over next 2, 3 to 4 years. So we are quite a bit about the overall capital goods sector. that's it from my side, and happy to answer any of your questions. Once again, we are very thankful to your valuable time, and feel free to put your questions into the chat box, and we will take each and every questions from you. Thank you.
Thanks a lot, Rajesh bhai. Should I start with Q&A?
Oh, yes, please.
Yeah. So first question is, how China Plus One will be favorable investment avenue compared to India, US, and other emerging market, since there is issue in education, real estate, and their legacy policies, the legal policies and regulation, how it would be better investment going forward in next 5 years?
Very good question. As I said, it is not China versus India. It is China plus one. When you look at China market and when you compare to India market, in fact, I think 6 months back, we made a detailed presentation about the cost comparison between China and India. So the labor cost in China has gone up significantly. The power cost in China has gone up significantly. So China, which was earlier supposed to be very cheap due to variety of reasons, is no more cheap. On top of it, you have a stringent pollution norms. All these things have resulted into significant increase in cost. And India cost is now comparable or at times even better than China, number one. Number two, when it comes to the reforms, Indian government in last 3, 4, 5 years have implemented series of reforms. Does it mean that all of our reforms processes are complete? I don't think so. Of course, we have a lot of things to be done even today, whether it is on land side, whether it is on labor reform side. It is an ongoing journey. But from where it was 3 years back, today we are in a much better position. Third, in education terms, the talent, the Indian engineering capabilities are very strong. So we have a good resource, whether it is a chemistry, whether it is a engineering, or whether it is a mechanical engineering or any stream. We are very good in science and engineering and mathematics. So these are the 3 important factors. If you hear the Cummins, in fact, Cummins MD has talked about all these drivers of growth, that why it is turning into India's favor. On top of it, what is happening is that the China last 18 months, switch on, switch off, lockdown, unlockdown, definitely this is not a good sign. And no customer would like to rely 100% on China. So we are very small compared to China. I mean, China is huge. Even if we can take 5% market share away from China, for us in equity market, for our companies, our portfolio companies, it is more than sufficient, because that itself will lead to 20% compounded growth for 5 years. So that's our view on China plus one. There are sectors which will benefit immensely, like specialty chemicals, agrochemicals, dyes, pigments, electronics manufacturing. PLI support from government is going to help it further. Like, for example, one of our portfolio company, Dixon, from 5,000 crore revenue, it is going to become 26,000 crore revenue in a matter of just next 2.5, 3 years. That is because of China plus one. And of course, the support by government. So government has understood that where is the weakness of India. Subsidies are not there compared to Korea, compared to China. Government started giving this PLI. Electricity earlier was very expensive. Today it is no more that expensive. And many more such things. So I think it is one needs to be, of course, very selective. But India is a huge growth to cover. And government is committed to reduce import bill. And therefore, it gives further scale benefit to Indian companies.
Thank you, Raj bhai. Now the second question is,
Your voice is
in capital goods sector, what are the major risks? Hello, can you hear me now?
Yeah.
So the second question is, in capital goods sectors, what are the major risks?
I think the biggest risk in capital goods sector is, if there is any significant slowdown into the economy. So if suppose the spending goes down compared to what we all think, if it goes down significantly, then that becomes the second important risk. So these are the only risk for capital goods is if there is a slowdown in economy, significant slowdown in economy caused by number of factors, like if the war continues, let's assume if the war continues for 1 year, oil price really goes to $200, it becomes high inflation environment, and that is a typical risk in capital goods. Second important risk in capital goods, not at the sector level, but at the company level, is what kind of customers you are catering to. So if you are catering to the customers which is a good balance sheet, you don't have a problem. But we have seen historically in last 10 years, there are many capital goods companies that went under bankruptcy because they didn't have the right risk management on working capital cycle. They didn't receive the advance money and the receivable got stuck primarily because you are catering to ACB, State Electricity Board, who do not have the right financial condition or something like that. So those are the important things which one needs to monitor. And that's why if you look at our portfolio, we are holding the companies with a zero debt and also holding companies which is a strong parentage. Most of them are global multinational parentage.
Now, the next question is, which are the sectors that will do well from the current level?
Well, I think, unlike 2018, 2019 environment where only select stocks delivered, we believe this time is going to be broad-based growth across the different sectors. It will not be driven only by one sector. It will be driven across, whether it is a automobile will do very well because the base in their favor. Last 4 years, nothing has happened in automobile. Banking credit growth is going to go up. As I said, the balance sheets are already clean. Credit cost is coming down. They have already adequately met a very high provision coverage ratio. So if the credit growth goes up, the profit growth will become very strong because NPS are already provided in the system. So we believe that banking and finance will do very well. China plus one, positive impact for specialty chemical, positive impact for electronics. Capital goods, we have already talked about the capital goods, the sector on which we are very positive. Consumer discretionary is also expected to do well. So these are the primarily sectors. It's going to be broad-based and sectors on which we are bullish on. I've already disclosed what kind of our sectoral allocation for our PMS plan. So those are the sectors on which we believe that will do reasonably well over medium term.
Now the next question is, what is your view on small cap versus large cap? Do you expect the small cap run to continue?
Good question. I think what we believe is that instead of looking at market cap, one should look at the profit size of the company. If the company is good with a reasonably large profit size, irrespective of its market cap, company will do well. So say for example, as I talked earlier, that in India, there are only 550 companies with 100 crores of net profit. If a 100 crore net profit company hypothetically gets PE multiple of 25, then market cap is only 2,500 crores. Correct? 2,500 crore means company becomes a small cap. Because currently the benchmark is roughly about 15, anything below 15,000 crore is considered a small cap, as on now. But that doesn't mean company is small, companies are pretty large. So one need to actually differentiate in terms of the profit size rather than market cap. And therefore, I believe if the company is good, whether it's a large cap, whether it's a mid cap, or whether it's a small cap, with a decent profit size, we believe those companies will continue to deliver reasonably well in the medium term.
Now the next question is, what is your view on specialty chemical sector, especially when the sector had already seen a 3-4 years of extreme run up? So do you see that, there is a steam left in this sector?
Oh, yes, definitely. We think that there is going to be, definitely long runway ahead for Indian specialty chemical sector. Our market share in specialty chemical is still significantly lesser. China is probably 3-4 times larger than where India is. If you look at the most companies, I'm talking about large companies, the market leaders in specialty chemical, they are seeing very high traction of demand from their customers. Many of these companies, they were very aggressive growth plans. They are already expanding their capacities. Last week, in fact, we met 2 companies during last week in our specialty chemical space. And most of these companies are identifying the new land parcels for their next growth phase beyond 2025. I'm talking about up to 2025, the growth is going to be very strong. But they have already started preparing themselves for the next level of growth. Because if I identify land today, then by the time it comes up, it takes about 2 years, 3 years journey from here on. So I think what we are hearing, what we understand from managements of our portfolio companies, they have very strong visibility. They are very upbeat about the demand outlook. They already proven, their capabilities, their competence. The exports opportunities are also very big. And as China plus one theme continues, it is giving additional volume opportunity for this company. In fact, one of the companies which we met, they actually rejected the few orders because they were not meeting their profitability standards. This was not the case 5 years back. 5 years back, Indian company never had a choice. You need to take whatever it comes because these are the first time orders. You can't refuse customer. You need to first prove yourself. But today, the Indian companies have came to a stage where they can probably even refuse the order if it doesn't meet your profitability standards. So we are quite positive on specialty chemical. Yes, one important thing I must say, don't consider chemical as a one industry. There are two types of industries within chemical. One is specialty chemical and one is commodity chemical. Please avoid commodity chemical space because there the price have zoomed by 3 times in last 1 year. I'm talking about commodity prices. So you've got inflated profit numbers. Now that kind of a profit number, it may not continue from here on for next 3 years. So please be very cautious about commodity chemical companies, but we are very upbeat about the specialty chemical companies.
Thank you. Now, there is a question for, according to you, as you indicated that big is getting bigger, but specifically from the banking point of view, HDFC merger with HDFC Bank, and it is emerging as the second largest or third largest company in terms of the market cap. So what are the implications you are seeing of this on the banking sector as a whole?
Well, I think clearly with the merger of HDFC and HDFC Bank, both are giants, and both giants coming together, as I said, it will become the one of the largest institutions in the world. So definitely it means that the existing banks, they now have to compete with the giant, correct? And to that extent, they need to prepare themselves well. Because when you're competing with 100 crore turnover, and if you compete with 1,000 crore turnover, and if you compete with 1 lakh crore turnover, there is a difference. So definitely there is going to be difference. And I think this also basically means that corporate India, the last 3 transactions of last 2 months, 3 months, it shows how corporate India is also thinking. It shows a tremendous change in way in which the corporate India is thinking, in the top management thinking. They understood the power of size. They understood the power of scale. In last 5 years, we have seen the consolidation of public sector banks. Today is the first time HDFC and HDFC Bank merge. Possibility there might be consolidation in the private sector banks. Who knows? Correct? So large size, power of size, I think power of scale is going to play very important role. And I think technology, because number of fintechs are also entering into the banking space. So technology on one hand, size on the other hand, and the customer experience and customer acquisition. That's a trinity which one needs to decide. So if you look at, for example, one of our portfolio company like Bajaj Finance, that constant innovation, they have launched the super app on the Bajaj Finance thing and the new app, number of cross-selling product, 5 different new growth drivers. Look at Cholamandalam. In last 6-9 months, they have changed this complete strategy. They have innovated. They have identified the new growth areas for the consumer space. And the new growth areas can add probably another 10, 20, 30% to their loan book over a period of time. So from 15-18% growth story, this company is now becoming 20-25% compounded loan book growth for next 5 year story. And that's the change what we are looking at. So management now have to think beyond from their existing areas, and they need to prepare themselves to compete with the giants. And in that process, I think you might see more consolidation and you will see more gains on efficiency side.
Very tricky question, but if you want to answer, what will be the probable expected return in your PMS in upcoming 5 years?
Well, I think I strongly believe that, as I said, market is mirror of earnings growth, and our portfolio earnings growth is more than 15, 18, 20%. I don't know what will the returns, but historically, as I said, market mirrors earnings growth. What is important is to keep investing into the companies which can grow earnings better than the benchmark. And if you keep doing it consistently, generally the returns follows.
Now, what is your view on the consumption sector, primarily when the inflation is rising, and if you see the staples are underperforming and discretionaries are outperforming? So your view on the overall consumption sector?
Well, I think you already answered the question partly. The consumption sector is divided into two space. One is the defensive and second is the discretionary. Defensive space is getting hit more because poor is getting hit hard as inflation is going up. It's a direct damage to his pocket. We have a zero holdings on consumer defensive from last almost now 9 months. We are very positive on consumer discretionary side, and that includes, for example, we hold Titan, we hold Trend, we hold the proxy real estate companies like plywood, pipes, wire, cables, and such companies. And we believe those are much better positioned compared to the defensive side.
Now, in recent time, inflation is running high and interest rates are also likely to inch up. In that environment, even though you indicated in your presentation, but how do your performance of your PMS portfolio likely to be?
Okay, what I understand from your question is you are talking about how our portfolio companies are positioned in terms of the rising inflation and rising interest rate environment. What is going to happen is if the inflation in both scenario, rising inflation, rising interest rate, while it's difficult to time that by when the commodity price will come down, or will it further go up from here 10%, who knows? What is important is what kind of companies you are holding in your portfolio. The pricing power is only with the leaders. Number 10, number 11, number 12 in the industry, they don't enjoy the pricing power. And that's why our strategy that we buy the companies which are the top 3 companies in the sector, they are tremendously advantageous situation. So for example, if the portfolio company, which is number 1 or top 3 or number 2 in the sector, if they decide not to increase the price, while in the short term margins may come down, but in the long term they will gain the market share because competitor will not able to sustain itself because competitor has to increase the price. And if they do it, competitor will lose market share. Or if the balance sheet of competitor, suppose there's a 2,000-3,000 crore of debt and the interest rate goes up by 100-200 bips, our portfolio companies are debt free. So competitor will again lose advantage because they have to pay higher interest cost and higher inflation cost, both. So naturally, the best way, somebody asked me last week that what is the best asset class in the rising inflation? I said, I don't know about the asset class, but if you invest into the companies which is a pricing power, that is the best hedge against the inflation. Because if companies can pass on the pricing, pass on the cost push to the customer, then the profit will keep going up better than the inflation because you have a naturally operating efficiency. So our portfolio companies are very well positioned for rising inflation and rising pricing environment. If your question is if the inflation goes up through the roof, then what will happen? Definitely market will come down, correct? Irrespective of the long-term fundamentals, in the short term, then market will come down. But the markets nowadays, the volatility is very high. It may come down and then people will realize that it is not permanent in nature and it will go up again. Maybe so at the end of the year, things might be different. In between, things might be different. So short term, very difficult to answer. But in the medium to long term, this is a very strong portfolio of the companies with a undisputed market leadership across the sectors. So I think we are very well positioned and that is getting reflected even in terms of our earnings growth. So if you look at our third quarter earnings growth, most of our portfolio companies have reported growth significantly better compared to pre-pandemic numbers. I'm not talking about a YOY. I'm talking about a earnings growth on a 2-year basis. Also, they have done extremely well. So to that extent, I think it's probably best of the quality companies what we are having in our portfolio.
So broadly, we are done with the question. If you want to give any closing remarks.
Oh, nothing. That's it from my side. I think just to conclude, we remain positive on equity market. We expect volatility to remain high because of some uncertainty, probably over next 1 to 3 months. Uh, we advise investors to take volatility to your advantage. Corrections are normal, so be ready for any such corrections. Add top up during such correction, take that volatility to your advantage. But otherwise, in the medium to long term, we expect equity market, good companies will continue to deliver strong earnings growth, and therefore equity as an asset class is likely to do reasonably well over medium to long term. Thank you very much, friends, for your valuable time. We will also keep this link recording on our website and YouTube. So in case if you have missed that, you can always look into that. Yeah, thank you, friends, and wish you a good happy weekend. Bye bye.
Thanks a lot, everybody. Now you can log off.